back many years ago, we used to have gas tractors, and then we filed and asked for the money back on that. You know, you take the federal, come off on the 4136, it come off on the federal return to state, you'd actually send a request in for them to send you the money back. The gas always has a gas tax on it. The diesel, they have what they call dyed and undyed. The dyed, it looks like red. That's for off-road use. And if you buy it for strictly that, they'll actually come on, go down the street and tap all the tanks in the pickup, make sure that you're not running through a diesel pickup. Make sure that you're not using the wrong tank, you know, because it's cheap. And so, but you actually, most of our gas that we buy right now, we don't worry about going back and asking for the gas tax because most of it's ran through the pickup, which is on auto use.
Yeah, we only have one tractor that uses gas, but I don't think you've ever.
It's not
enough.
It's not enough to worry about.
But if you do have a gas tractor,
yeah,
and you're paying, and you're just getting it at the gas station, well, on the tax return, we can sort of reconcile and get, let's see, 18.3 cents per gallon back for you. And on diesel, I mean, if you're not having big bulk tanks on your farm, you're getting it at a gas station. I mean, in that case, if you're using diesel for non-taxable use for farming use, in a tractor or anything else, I mean, we can get 24 cents back on diesel, as long as it's not dyed diesel. The difference is non-dyed diesel has the tax on it. Dyed diesel, which our diesel is red, doesn't have the tax on it. Well, heck, we can't get money back when it wasn't there to start with.
If you live out of state, can the state still come after you on the farm?
Say again?
If you live out of state,
yeah,
can the state still come after you for your farm expenses or taxes?
Well, the farming operation is actually in Illinois.
Yeah.
The farming operation, see, we have people that move to Florida and then they sell either their houses or they rental houses or they'll sell their farm ground up here. And when they'll say, well, I'm a Florida resident, there's no taxes out here. Yeah, but you didn't move the farm down there. The farm's still in Illinois. So when you file that tax return, you're going to have to say that that's the Illinois farm. Oh. And you'll pay Illinois income tax on that. So,
I mean, if you're going across lines like to Indiana to sell your stuff, that's a whole different subject. But if you're just staying in Illinois, say you're going to Kankakee to the farm market or anything like that, then that's strictly an Illinois issue.
Yeah, I was thinking back to Florida.
Yeah, you can't just.
He had about 4 rentals up there, and he moved down there, and he said, well, I sold my rentals now. And so I sent him the tax return, was included in the Illinois tax return. He said, why am I getting this? I'm a Florida resident. I said, yeah, but you didn't hook onto those rentals and pull them down Florida with you. They're still in Illinois. If they're in Illinois and you sell that, you're going to get hit with Illinois tax.
See,
they're slow, but they're not that slow.
We have a lot of guys, especially from Watsika, because we're so close to Indiana, that they think that since they work in Indiana, Illinois doesn't get a piece. Well, Indiana initially taxes it, and then we get a credit to other states' tax paid to Illinois. The biggest difference is Indiana's tax is 3.4%. Illinois is 5%. So we got to make up a difference of 1.6% there. And that's why usually guys that work over in Indiana, they only withhold 3.4%. And then when it comes over to the Illinois side, make sure that Illinois is getting their piece of change because you're an Illinois resident. We usually owe them money.
We make that up through, if it gets to be too much, then we make that up through estimates or get them to over-withhold.
Yeah. But we got pretty much 3 different things you can do on that is estimates. We got some people that just over-withhold on Indiana tax. We got other people that causes us a little bit of problems is they take the 3.4% of Indiana tax and then they do maybe like a 2% withholding on Illinois tax. That gives us a little bit of a problem because we have 0 wages but a little bit of Illinois withholding. For our computer system, it always causes a problem for us. Any questions on the gas tax refund? I mean, if you're doing small stuff, really like tilling, putting gas in that.
We file it even for guys that do lawn mowing and stuff like that because, again, it's off-road. And if you're doing a lot of lawn mowing, there's a credit for it. And it comes, there's only 3 main credits that will actually give you back money that if you don't owe any tax liability. And gas tax is one of them. The gas tax and then the earned income credit and then the
expenses. Really, this is the side that you more need to focus on, because expenses is very crucial and it's very discipline oriented. So the main ones really for vegetable that I was thinking of was seed, fertilizer, possible utilities. I mean, it'd be hard to not say your garden's in the back of your house. And you have to use water, obviously, water your garden. If we haven't gotten rain, say we're in June, we haven't gotten rain for 30 days, we've got to use water. Well, if you're on like city water, some of that bill can be apportioned to your garden, so the Schedule F can go against for business expenses. Or if we're out in the country, it's well water. Well, what pumps the well water? It's electricity. So we can put some electrical expenses on the Schedule F for you to offset. Other utilities, I mean, Jahar was talking, she's got little chicks, it sounds like. I mean, that electricity to keep it warm for them so they don't die, we can use some of that electricity. It's hard to apportion sort of what is the correct percentage because, I mean, you get one bill. But, I mean, at least apportion something to it. It might be a little bit off, but, I mean, if you go like a tenth of whatever your electrical bill is, and you think that's for the electricity that you use to pump your well, to heat certain stuff, that type of stuff. A lot of our stuff is done by ratios. So we just keep it a tenth for the rest of this person's life. But it's very important that we include the utilities on there because
it's okay to live on it, you just don't want to kill the tree.
Yeah.
Don't get ridiculous where it's 100%.
Yeah.
A lot of electricity puts the water in the garden.
Well, they're looking at that. Okay, you used this last year. You should have the same amount that you use in this year, unless you get something bigger.
Well, and then that's what you look at, what you're supposed to be looking at is what was the additional cost required in that garden if you didn't have the garden vehicle.
Right.
And it's sort of a ballpark deal. The idea is that they can always argue with the percentage, but they can't say you're wrong because your idea of how much it was and their idea is two different deals. So try to be reasonable. We don't want to be fair to the wind, basically, if it come in and look stupid. We don't want to look stupid. Again, we have to have a talking point. So if you're running a house and then you've got, say, 15 or 20 acres of garden and stuff into that, and at the most you would think to be half, because for half the year you don't have the garden out there because it's too cold. The other half of the year, if half of the was for pumping water out to that, and you take 15, 20 acres, it's going to take a lot of water.
That's common sense.
Yeah, it's common sense. Yes, common sense. What do you, if they called you on in, you wouldn't feel embarrassed, and the agent wouldn't be laughing at you saying, you've got to be kidding me, And if we stay below that, we can go a little bit on the high side. Like I say, we can whittle on them, but we don't want to kill the tree.
we don't want to be stuck with, well, what was your electrical bill? $34. What'd you stick on that Schedule F for that month? $34. We don't want to do that. But I mean, to say that they could have a problem with us taking a quarter of it or anything like that, they're not going to have a problem with that. And then hay and feed, especially for the cattle girls back there, is very crucial to keep track of. Depreciation.
I always want to keep one thing in mind out here. Hay and stuff, if you raise that hay, now you've already deducted the cost of raising that hay, so you can't take what that hay was worth. You can't take that off as a deduction because you really don't have a cost basis because we've already written off the expenses of raising that hay. One time. They don't mind the first time, the second time they sort of complain about it.
But are you guys buying your hay from someone? Sometimes? Okay.
Sometimes.
If you're buying that, just keep track of that and we'll take that off for the first year. Depreciation. So we're looking at two main things, and these are our main changes possibly for 2014 tax year. Section 179, what we mean by this is, say you bought a $20,000 tractor. What Section 179 says is we can either elect to depreciate it or we can elect to Section 179 it. Just take the whole $20,000 off the first year that you bought it. But the biggest thing for Section 179 and bonus depreciation for 2014, if they don't extend these laws, is Section 179 will be limited to $25,000 and bonus they'll take completely out. What bonus means is, say we bought the tractor for $20,000. If we elect to bonus it, then we get 10,000, so we take half, and then also we get, say I straight line it over 5 years, then I get another 2,000. So we can take 12,000 off and then only have 8,000 left.
Now, the main difference between 179, you can use that on new and used equipment, whereas the bonus really is only available for brand new stuff. Okay, somebody else has to take the plastic off the seat.
Now these laws are basic laws, like 2014 up 2015, it doesn't vary that much.
We're hoping it will.
Yeah.
Because right now, they're cutting it from 500,000 last year down to 25,000. Now, anything with an engine, you ain't gonna buy anything right off the here if you're a farmer. And the biggest thing is, they're going to limit, right now it's around $2 million. You have to have about $2 million worth of equipment bought before they start cutting back on Section 139. If they go back to the 25,000, anything over 200,000, so if you buy a $225,000 machine, they're not going to allow you to write off anything the first year for Section 179. Now, you still get your depreciation, but you don't get any Section 179 because for every dollar you go over that 200,000. So they need to change that. That needs to be extended from what we have currently.
And that probably, when was the last time they had that?
As far as
Depending on whether they extended it. Wasn't it a couple years ago?
yeah, it always runs about 6 or 7 years. They pass laws for 6 or 7 years from these, and then they extend them down the line.
I mean, when you're
Congress right now isn't doing anything for anybody.
Right.
I mean, they're all fighting like crazy. And I don't know what we're paying for.
when you're just looking at a truck that costs say 40,000.
Yeah.
I mean, combines now cost 400,000. I mean, these farmers need something in order to write off all the income.
What? Hold on, wait.
Yeah.
Now, you renting the tractor, or you buying it. When you buy it, you want a different. You can use that Section 179.
Right.
But if you renting it,
Then you just only get to write off if it's a true lease, you only get to deduct the lease payment. The only thing is, that guy that you're renting it from, he's got that cost figured in there already.
Okay.
You're going to pay more, you would think if you negotiate good, you should be able to buy it cheaper than the rent it, because that guy's already he's got a profit margin figured in there too. It's very simple. All you remember on a lease, remember who's writing the contract, it ain't you, it's the other guy. And they always protect themselves.
right?
Breed stock, like we said before, hogs, if we're going to appreciate the breeding stock, 3 years, goats and sheep, and cattle are 5 years. But I mean, like we were saying before, we can always Section 179 depending on the cost of the breeding stock. Vehicle expense. Let's look at the difference between depreciation and just taking the mileage number. The biggest thing on Section 179, like say we bought a truck and it's over, say, I think 3/4 ton is our difference between.
Even a half ton will qualify most times.
Over
Usually
6,000 pounds.
the S10s and stuff like this, the Ford Rangers, they were under 6,000, but really a decent heavy half ton will be more than 6,000 GVW. And so at that point, it takes the restrictions of using what they call a light duty vehicle off. And so.
Yeah, because there's a big difference between trucks, big trucks, say over a half ton or 3/4 ton, and light trucks or cars. If we're under 6,000 pounds, number one, we can't Section 179. Number two is, when we depreciate it, we can't go fast on it. It goes real slow. I think we were figuring on a truck that was 40,000, and we did Section 179. It takes 14 years in order to write all that cost off. Now that doesn't mean you got to keep the truck for 14 years. It just means that, that is a long time to spread that cost over.
We've got a lot of people that they trade cars every 3 or 4 years. They've got 3 cars on their depreciation. Only one of them is actually in the garage. The other 2 were traded off before, but we have to keep doing that until we run that cost down.
So the biggest thing on, number one, a lot of people are confused on the difference between depreciation and mileage. The mileage number for 14 is going to be 56 cents a mile. In that number is depreciation of the vehicle, insurance, repairs, oil changes, tires, all this type of stuff.
And the fuel.
Yeah, and the fuel. And we just take one number for all those miles. For depreciation, we're taking the cost of the vehicle, and then we're taking gas, diesel, oil changes, repairs, that type of stuff.
Now, the big thing there is if our use is less than 50%, then we have to go straight line and it slows it way down. If the section 179 we can't use at that point. If it's more than a 50% use on a vehicle, and if you're already a full-time farmer, they sort of give us a freebie, that if we use on one pickup, they'll give us 75% and we don't have to keep track of any of the mileage logs and stuff like that. So that's sort of a nice deal for the farmers. We can take 75% of the cost of the depreciation, the fuel, licenses, repairs, anything that goes in to run that truck.
Suppose you're using suppose you plow somebody else's property,
Well, mileage is only for vehicles. Are you talking snow plowing or plowing with the tractor?
Plow with a tractor.
Well, you don't take, we always depreciate that. We either depreciate it or expense it. The mileage number is only with autos. So for cars, trucks, vans, that type of stuff.
All right.
Something that you can use what they call personal.
Right.
Anytime that you have a tractor, you're either using it as a trade or business. Either you're doing it for your neighbor or doing it for yourself. Now, if you was actually bought a piece of equipment and only used it for custom hire, didn't have any yourself, then that really isn't a Schedule F transaction. That's a Schedule C, because you're in the business of leasing off personal property or leasing off the equipment. So that's a different deal.
All right.
Okay.
But really, don't we find that most mileage numbers end up paying out more than what? I guess that.
If they're a salesman, I'm sorry, I've never had, in the last 5 or 6 years, I haven't had anybody. See, way back when, about 1980 something, they used to have a deal where the first 15,000 they gave you that full rate, that's 56 cents. And then anything after that, they went to a lot lower rate because they figured that the depreciation had been used up already, at that point. And so they made you go cut that way back. Then in about 1980, whatever, they switched it and said, we'll give it on every mile. Well, so if you got salesmen driving 60,000 miles a year, 60,000 times 56 cents, that's $30,000.
That's more than the car that most salesmen, they drive junky cars because they know they put that many miles on. So that's more, in 1 year we paid for it. Then instead of just depreciating or taking Section 179.
Okay.
So that's where it sort of takes a balance of, do we want to do this or do we want to do this? Because once we choose which, we're sticking with it.
The only time that you use the actual mileage is if you have low miles you put onto it, you've got a pretty new car, and you don't, so your overhead's high. That's where you use the actual depreciation. The other way, if you've got a guy that's driving a lot, you go to the 56 cents and you take it on an older vehicle, it works out, you make money like crazy on that.
Well, I mean, for you guys, depending on where your actual place of business is, if you got a garden in your back home, I mean, that's your place of business. If you got to run to get seed, say, in Kankakee, take that mileage between your house to get the seed and round trip back. I mean,
Always want to remember one thing, though. When we talk these $30,000 deductions, then we have to get realistic. You take it down to 15% tax bracket.
Yeah.
Then it doesn't look near as attractive, because that $30,000 deduction at 15 cents is actually like $4,500. So people think, well, I'm going to make money off the deduction. Well, you always have to run it through the tax bracket before you get down to dollars in your pocket. So if you take 15 cents on, say, if you drove 30,000 miles, $4,500 is that's the actual deduction, the actual cash in your pocket. That doesn't go very far in my home.
And they're always looking at the ratios of, say you're making $10,000, but you're driving 30,000 miles. They're going to look at that and say, you should have more income. I mean, to substantiate 30,000 miles that you're driving, you got to have more income in order to justify that number. So they're always looking at the ratios between what did you make, what are your other expenses, and how much miles did you drive. Because I mean,
they really want the law.
what you're realistic, what you're supposed to do is starting mileage, ending mileage, and then trip. What was the reason for the trip, and then what day it was. That is realistically what you're supposed to do. I think over 1,800 returns, we got one guy that does that. Everything else is estimations. It's based on previous use tax returns, and really sort of, we take a short segment of a week. What did you drive in a week? And then we just take that over 52 weeks. It's rough that way, but I mean, for some people, that's the only way we can get through it.
But if you get into an audit,
Yeah,
and you don't ask, if the guy, most of the time they don't get into it if you're reasonable on the mileage. But if you get ridiculous, like he says, 10,000, you go 30,000 miles, the first question is, give me the proof. And if you
So,
don't have it,
do I deduct that mileage from here to Florida? 4 times a year?
where are you going to Florida for?
That's where I live at, and the farm is here.
You live in Florida?
Well, that's the,
Your actual place of residence is in Florida.
yeah, let's say that, yeah.
Well, you can't just say that. Number one, they're going to be thinking, so you come up here 4 times a year.
See, that's really,
Yeah.
You want to work the farm?
Well, yeah.
Right, but your place of business is actually the farm.
Yeah.
Right. So it's commuting miles. We can never take mileage from commuting miles. So
But that's
coming from
same way
Florida to here.
We live in Clifton, and the office is up in Bourbonnais. We can't deduct that.
Right.
But if I sold that product in Florida, I could take
And
that.
then you got something different at that point. But that's a long, you got to figure out, again, like I was saying before, though, you take your 15% of whatever that mileage was, you need to take a look at that versus the cost of hauling clear down to Florida. What are you going to actually net? The fact that you got a tax deduction, you always want to remember you're throwing a buck to save 15 cents. If that makes sense to you, don't say me for every time I give you back 15 cents too. And I've never had in 30-some years anybody with quality.
So how many times can you lose money over this business?
Generally, the law says 2 out of 5.
2 at a time.
Yeah,
And
2
then
out of 5 is
the-
your profit. And you can lose money 3 out of 5. Now, that's not the only thing. They have like a 20-point test. I mean, you have to look like a duck, walk like a duck, quack. But if you do it and trying to make a profit, the fact that you lost money, say, for 3 years instead of 5, instead of making money out of it, that automatically doesn't say, you're knocked out the deal. But you better be able to back up with good accounting records. Just like the lady was saying up here, you got to have a business plan and all this other stuff. You've got that, and you can see where it's going to turn around. The word that you don't want to hear is hobby. Because hobby says you can deduct the expenses up to the income, and at that point you shut it off. And if you're going to have a loss, you're going to go beyond that.
The biggest thing on yours, if you're going down, deciding to go down to Florida to sell it, they might disallow all those miles anyway because they might say, it's your choice that you go down to Florida, but you could actually sell it 10 miles away.
They used to have a Shockley product here. They used to have the deal that they had a tape on it that said, as long as you got 2 cars, you can deduct 1. Even if one's in the backyard up on block. That doesn't work. The other thing is that they used to say is, as long as you're carrying product in the car, it's almost like the Holy Grail, that every mile you drive is deductible. That's again, reasonable and common sense. There's no reason why, if you're going to go, say, to church, and because you got a Shockley product in your back seat, that's deductible. I mean, you're calling an apple and orange.
I mean, when they come back with these letters and we have honest mistakes saying, dang, we missed a number or something like that, I mean, there's a big difference between we made an honest mistake and an accuracy-related penalty. I mean, they kill you on accuracy-related penalties.
Well, they have an F word, and that word is fraud, and that's the ones where you go to jail for. That's where different ones that the movie stars, they come into some deal and they think they're going to get by. If it sounds too good to be true, it usually is, guys,
What you're saying is, you can be reasonable, don't be stupid.
Exactly.
And this is, you're not doing them to scare people off, but you're telling them the proper way to go about it.
Right. There's a way to play the game. I'm lousy at basketball because I foul all the time. But there's a way to play the game. As long as you know how to play the game, then you get by with it.
Well, our biggest thing is always, it's your name on the tax return, but we're the ones that sign it as well. So, I mean, it's not only your neck out there, it's our neck too. So we want to make sure everything looks decent. That's why we get some people that don't come in there with anything, and they go, just make it look decent. Well, that's a heck of a lot of burden on us. What you got?
As far as the depreciation, the vehicle is used for transportation during business. Does it matter how old it is?
No.
Not in the 56 cents.
No.
And on the other, you can whichever is lower.
So
So if you bought that car 10 years ago and...
the city bought it 10 years ago for $10,000, but now you say you got 200,000 miles. If it's worth 1,000, we go off that 1,000, and that's what we depreciate. So really, in that case, it would make a heck of a lot more sense to take 56 cents a mile.
So mileage is strictly business, so coming here from my house is just, that's the commuting.
Now, where's your place of business?
Now, if I work out of my house and here, would that be?
What do
Like
you
say
mean?
I live in Chicago, have a little backyard growing in here, and I'm also coming out here for classes. And
Now, if you live in Chicago, and you come straight here, that's commuting miles. If you live in Chicago, say your farm is 30 miles away from here. You live in Chicago, make a trip there, and then you come from there to here. That mileage we can take. If your main place of business, we're always looking at where is your main place of business. Because normal W-2 people, they can't take this mileage because it's commuting miles. If you're going from home to, say, Bungie or CSL in town there, you can't take that. But if then, say they send you to another factory, so then you're going from CSL to another factory. We can take that mileage as long as they're not paying for the vehicle, they don't reimburse you, stuff like that. So that's where, like, we can sort of find gray areas in this. If your home is, say, in Grant Park, your farm is 10 miles away, and then from here to here is, say, 20. We can take that 20 as long as you stop at your farm. That's your main place of business. We can call that 10 miles between your home and your farm community miles. Everything else is business miles.
Now, say I'm growing in these different places in Chicago. My backyard is one of them in Chicago. Is that a business to school to?
Well, where's
Is that too?
If it's a big enough garden,
Yeah.
if it's actually used for production of income.
Yeah, we can't just have like one little plant here and being able to do that.
They used to have people that they were teachers, and they would buy 2 steers out in the backyard. They raised those 2 steers, and then they thought they could deduct that mileage. Well, again, you hit the right IRS agent, he's going to say that's a sham, you know. And then again, you got to be reasonable. Now, if you had 30 head out in the backyard, and then you would teach him beside that, then I could see that, you're going from one business to another. That's secondary employment. But again, be reasonable.
Okay,
We're going to
So I have to have
a 15-minute break. Don't y'all feel like y'all need a break right now?
Wait a minute, one question. I want to know if I can farm in Florida,
We're going to come back in 15 minutes.
then I can have a business trip back and forth. If I went in Florida and in
If you had a productive farm in Florida and a farm up here, possibly.
Again, be where you can be proud of it if they ask you about it.
very good.
You see what I'm saying? Don't just be just a couple of potatoes down there.
Tracking mileage from classes to home, so that's like a weight use.
I'm going to spend farm in
Well,
Florida.
Even gas.
education really, if it's an education process, now that's what we have people that are financial planners, and they just go to a seminar someplace. We take that mileage. So if what you're saying when you come here, if you're saying this is strictly the only reason that you're coming down here is strictly for education, then that mileage is deducted.
The main question is, are you doing it to gain more income? If you are, it's usually taken.
okay, I live around Chicago, and I come here, property, the land is here. The crops and everything, I get here, and I take them back to Chicago.